please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Markets do tend to trade together, especially in times of stress.
This market is off the day's lows, but still very much in negative territory.
The first tick is 1,200 gone on the Sensex. 33,500 is gone.
As we jump into the session, you can see we are mostly in the red. There's about 3 stocks that have made it onto the charts in the green.
Asian stocks firmly in the red for the second straight day after the Dow Jones's 1,000-point drop overnight.
It has been such a volatile day of trade. We have recovered from the lows, but still the market closes, the Sensex closes with almost a 500-point cut.
We of course can see we're going to have a lot of red on the board back in the real-time screen.
Well, that has been the global market action. Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The top story is the opening bell today. Dalal Street plunges to its lowest level in 2 years. The signs were ominous with markets sinking across Asia thanks to the sharp overnight fall that we saw on Wall Street. But just a few hours after we opened, the Sensex was clocking losses of over 1,000 points. But it did recover during the trading session. The bulls staged that recovery with the Sensex gaining over 700 points. Look at that intraday graph. It tells you the story. But nonetheless, it was the 6th straight session of losses for our markets. The Nifty is back below 10,500, with just 4 out of the 50 index stocks ending in the green. Mid-caps mirrored the fall in the blue chips. At 1.42 stocks were declining for every advancing stock. Now, this improved by the end of trade to about 5 stocks declining for every advancing stock. Anuj is standing by now to explain what was an extremely volatile day on Dalal Street. Anuj, a 6-hour roller coaster ride.
Big roller coaster ride. In fact, I'm a fan of roller coaster ride, but I think those in the market today may not have preferred something like this. Just take a look at what happened today. The Sensex opened at 33,753, immediately made a low of 33,482, but after that saw sharp intraday recovery. In fact, almost a 800-900 point intraday recovery is what we saw, 34,521. But once again, towards the end, there was some selling pressure, and we finally ended at 34,195. It was more pronounced in the Bank Nifty's intraday chart. If you take a look at that, opening at 25,140, immediately going to a low of 25,023, as you can see in that graph. After that, look at that sharp move at around 2. Once the Dow futures turned in the green, it went and made a high of 26,140. Before closing once again slightly lower at 25,811, as you can see on the screen. Amidst all this, Dow futures saw an intraday move of 600 points. So from being down about 400 points at one point, the Dow futures were up 200 points, and that sort of continued across the last hour. The problem is that the global markets have seen a bit of a risk off, and the catalyst this time is a reversal of a product called short volatility. Essentially, there was a product where you could just short the volatility, and because you saw a huge rally in the volatility index, it was more a case of the market leading indicator turning a bit of a lagging indicator, and that's what happened in today's trade. In terms of individual stocks, just take a look at how some of these stocks moved. HDFC Bank, HDFC, I think intradays would have been better, but both these stocks, after big declines, saw intraday recoveries as well. On the other hand, IT stocks, TCS, Infosys, they were dragging markets big time. And of course, Lupin, post the numbers as well, was down quite a bit in trade. But, the big recovery was reserved for a lot of non-index large caps and mid caps. Once again, intraday would have been better, but if you see stocks like M&M Financials, Mindtree, Page Industries, Jubilant Foodworks, Canfin Homes, now they're showing gains of 1 to 3%, but all of these stocks started about 10% lower. So intraday, there was a big 10% rally. Short point here is that right now, the global markets are in a state of flux, and nobody knows what the next move is going to be in the global markets. And that's why perhaps maybe sitting on the sidelines could be the best strategy. That's what the experts tell us.
Well, the markets are going to be tracking the U.S. markets overnight. Anuj, thanks very much. That was a story back home. But let's do a quick check of the U.S. markets. Remember, they opened lower, then recovered, and now both the S&P as well as the NASDAQ. The NASDAQ is absolutely flat at this point in time with a green tick. The S&P is down by almost 1%. But the European markets continue to trade in the red. The French CAC, the German DAX, and the FTSE all down over 1.5% each. CNBC's William Marks joins us now with the latest on European equities. William, the markets are in negative territory. They have managed to trim some of those losses. What's weighing on market sentiment?
Well, you know, it's the inherited movements we've seen in the US yesterday and then Asia this morning. Of course, far worse in Asia over the course of the day than it has been here in Europe. And yet, going into the trading session early this morning, we saw the futures pointing to a very soft open, and it's pretty much stayed that way throughout. As you mentioned there, they've pared back very slightly. We may have seen that rally in Wall Street having a bit of an impact. We're about an hour before the close here on most of the major European markets. Just to run you through some of the numbers, though, FTSE here in London down more than 1.5%. The DAX in Germany with just under an hour's trading left there, that's down more than 1.75%. The CAC 40 in Paris, those 40 stocks that are watched so closely by the French in particular, that's down, 1.9% at the moment. A big focus for spread bettors, of course. And as your colleague there mentioned, this is very much to do with volatility. We've seen it very, very, very low until relatively recently. And then as of Friday, we saw that VIX shoot up. And a lot of people trying to find liquidity in that market who've been taking short positions on the volatility on the VIX. And we're now seeing some of those trades unwinding and a real impact across the board in the major European markets.
Well, William, appreciate you joining us. It's a quick check of the European markets also coming off their intraday lows just a tad, but nevertheless cuts of about 2% apiece there for the FTSE, the CAC and the DAX. To discuss global markets and India, we're now joined by Jan Den, Head of Research at Ashmore Investment Management. He joins us from London. Jan, appreciate you joining us here on CNBC TV 18. You know, what we've seen over the past 2 years, especially when it comes to the US market, is a steady up move in one direction. There's been absolutely no sign of a correction. And today, or over the last few days, we've actually seen the market crack. Is volatility now going to be the new normal that we need to get used to, Jan?
Yes, it is, because unfortunately, U.S. markets, but also other developed markets, have been absolutely ignoring the possibility of inflation ever coming back, which is very irresponsible if you think about it, because the entire recovery in Western economies has been predicated on hyper-easy monetary policies. And so now that inflation is back, suddenly the prospect of tighter monetary policy follows closely afterwards, and none of this has been priced in at all in developed markets. So yes, we are likely to be heading into a period of considerable more volatility emanating from developed markets.
So, Jan, given where we are seeing the markets today, the Dow started lower, recovered. It's now down about 81 odd points at this as we speak. You know, how much lower on an average? And I was looking at the work that Ruchir Sharma at Morgan Stanley has done for the New York Times, saying that over the past 3 decades, on an average, the US market has dropped about 10% a year. That's the kind of correction that typically we've seen. And we haven't seen that in the past 2 years. So what would you expect now in terms of a correction?
I think the fuel that's going to continue to drive this has a lot to do with the commentary that we're going to get from the new Fed chairman. This market sell-off has coincided, of course, with the change in leadership at the Fed, and that certainly adds a further degree of uncertainty, because we don't know what the reaction function is going to be of the Fed. Not only do we not know what exactly Jerome Powell is going to do, but we also do not know how the Fed is going to react to inflation in general, because we never had bad inflation under Yellen. So there are 2 major pieces of uncertainty. If I was to place a bet here, I would argue that the Fed is probably going to be more concerned about protecting the economy from a massive downturn than fighting inflation at this stage, because core PCE inflation is still running at 1.5%, so well below the Fed's target. So there's room. I think the Fed's approach here will be to err on the dovish side, and that should provide a bit of temporary relief for the market once the Fed comes in and starts making comments. But it doesn't change the fact that inflation is likely to drift higher over the longer term. And that, in turn, if the Fed is dovish, that raises a question about the long end of the U.S. yield curve, which is where I'm particularly concerned, because the long end will have to price in an inflation premium, which is simply not there at the moment. And that could be quite painful for the housing market and other parts of the economy.
Yeah, as you pointed out, the market hasn't priced in that inflation premium. But since we're speaking about central bank action, Jan, we've got the Monetary Policy Committee here in India, and markets will listen to the commentary very closely. While our poll suggests that rates are not going to move higher just yet, but the tone and tenor of the commentary could perhaps be more hawkish. What is it that you would look for specifically from an India standpoint, given where our markets are today?
I would be looking for the RBI to keep its eye very firmly on the medium-term fundamentals and not to be too moved by the short-term volatility that has been created in connection with the issuance of the budget recently. I think not only did the budget come out, which obviously had an effect on equity markets due to long-term capital gains tax, but there was also an adjustment in the fiscal trajectory, which had an impact on the bond market. And that coincided with the turmoil in the global markets. So actually, the RBI at this point needs to show calmness and steadiness and to take a view through the short-term volatility and indicate that that everything is fundamentally okay in India, which in fact it is. So that's what I would be looking for from the RBI.
So my final question to you, Jan, given the fact that you believe that the India story is intact despite what we've seen on the long-term capital gains tax issue, what's the outlook then for the Indian markets in the near term? We've been mirroring the fall in the global markets. We did recover quite significantly today, but nevertheless ended about 500 points lower. What's the take on the Indian markets in the short term?
Yes, I think the Indian market has been caught up perhaps more viciously than other markets by the uncertainty created by the budget, by the foreign markets, as well as the fact that the Indian markets have been more expensive than other markets. So it's been vulnerable to these short-term effects. However, these short-term effects, for example, the long-term capital gain, is very much a one-off adjustment. And as such, I think these effects are going to fade, and then we're going to be coming back to the longer-term story, which is actually one of still gentle fiscal consolidation over the next few years and less political uncertainty, I think, going forward than we've had before the budget. So I don't see this, and I think many of the reforms that have been done are going to start bearing fruit over the next 12 months or so. So I think, broadly speaking, this pullback is really an opportunity to add at a more attractive entry point.
Okay, so the fall in India is an opportunity to buy. Jan Den, old India watcher, thanks very much for joining us here on CNBC TV 18 to take us to the global market action as well as the action on Dalal Street. But here's something that the markets will watch out for, and this is a CNBC TV 18 exclusive. Top government sources tell us that while currently there is, and I'm stressing, no proposal for any relief on the long-term capital gains tax, there may be a case for the same. This particularly for investors who've held on to blue chips for a long period. Now, government sources also say that changes or clarifications, again I stress, if any, may come through amendments to the finance bill. Sapna joins us now with the details. So Sapna, there is no official proposal at this point in time. There are options that government is looking at. No decision has been taken. Again, I'm underlining that. What are you picking up? What's the thinking?
Government officials have told CNBC TV 18 that indexation is a legitimate demand, and there is still time to make changes to the finance bill if required, because this levy will only come from 2019 onwards. So there will be still time to bring in changes. Probably a clear indication that government may be slightly amenable on the indexation front for LTCG. Apart from this, even despite the grandfathering, the fact remains with a lot of long-term investors who hold blue chips, say over 20 years, 25 years, they will still be left holding some bit of their portfolio after 31st Jan, which will have capital gains. And obviously from the new financial year onwards, this tax is going to remain. That's what the understanding is as of now. So hence, some kind of clarity on the indexation front will be required. There's also another option. There is also another point. What happens to STT? Well, so far the Finance Secretary is very clear that it remains. As of Feb 1, he had made that point very clear. But it was said that the policy perspective is that STT needs to be abolished once LTCG comes in. Will the government do that? Because they've already targeted 11,000 crores via STT for FY19. So would it be possible for them to bring the rate down to zero, but still continue with STT? Well, not very sure about that. But these are the policy options for the government. And let's wait and watch and see what happens at the time of movement of the amendments to the finance bill in the month of March.
Thanks very much, Sapna. These are only options at this point in time. Again, there is no decision, and a decision, if at all, will have to be moved in amendments to the finance bill, which is closer to March. Now, the Reserve Bank of India will present its policy review tomorrow. This is going to be the next trigger for our markets. A CNBC TV 18 poll suggests that the RBI's Monetary Policy Committee will hold fire this time. However, majority of respondents also believe that a 25 basis point hike is likely in this calendar year. Ritu joins us now with the highlights of the CNBC TV 18 Monetary Policy poll. So, Ritu, hold tomorrow, but a hike sometime this calendar year.
Well, the bond markets and as well as the banks have already signaled the end of the rate cut cycle, and that is what our poll predicts. The Monetary Policy Committee will also do on the 7th of February. 100% said they do not expect any action on the repo rate front. In fact, we asked them what action they see for the entire calendar year, and 40% believe that the rates will be left unchanged at 6% throughout 2018, but 60% believe that with the risks to inflation rising, there is a chance of a 25 basis point hike in the second half of this year. We also asked them the statutory liquidity ratio, if any change is expected, but none of the respondents expect any change on SLR. On the macro, however, the street was more divided as far as the FY18 GVA forecast of 6.7% is concerned. 50% of the respondents believe that it will be left unchanged, but the other half believed it could be lower to match the CSO estimates. On inflation as well, this 4.3 to 4.7% forecast for the second half of this year, a majority believe will be raised given the threat to inflation from rising crude oil prices, as well as the government's promise to increase the minimum support price can both impact inflation in the second half of this year. For FY19, 90% believe the range will be left unchanged for now, but there could be revision later when more data emerges. We also asked them what the tone, the stance of the policy will be. 100% said they expect RBI to maintain the neutral stance. And lastly, we asked them the statement itself, will it be more hawkish or dovish to the previous policy? The majority believes that given the risks to inflation, it will definitely be more hawkish than what we saw in the previous policy.
All right, Ritu, thanks very much for taking us through the highlights of the CNBC TV 18 Monetary Policy poll. But let's go across to Lata now. She is going to be at the Reserve Bank headquarters tomorrow. Lata, what are the markets going to be keeping an eye out for in tomorrow's decision? Will a pause mean good news for the markets, Lata?
Well, what the poll is telling us is that the markets are pricing in a pause from the Reserve Bank, but a hawkish pause, that it will point out to dangers of inflation ahead. If this is indeed the outcome, then actually it's bad for the bond markets, because the sword will hang over them that another hike is going to come, probably as early as April. What perhaps could be better is if the Reserve Bank hikes but says that we are still in a neutral stance, which means it is like one and done. And for the markets, at least, it's a near-term relief. Actually, the futures market, the overnight index swaps market, as we call it, is already pricing in 2 rate hikes in 2018, and maybe, therefore, a neutral hike will be a relief. Okay, that said, what will the markets watch out for? The most important number will be the March 2019 inflation forecast of the Reserve Bank. At the moment, the Monetary Policy Review report expects that it might be around 4.5%. That is March 2019, 15 months from now. If the Reserve Bank were to give a guidance below 5, that will be very positive. The second thing that the markets will watch out for will be what it says about MSP, the minimum support price structure, and the pushing back of the fiscal consolidation, the 3.3% fiscal deficit, as well, of course, whether the RBI is saying anything to cool down the yields, whether, there is today a buyer's strike, people don't want to buy long-term paper, whether it says anything to smoothen or smoothen frayed nerves in the bond market. So much to watch out for in the RBI stock and, of course, in the RBI's walk.
Well, catch our live coverage. Lata will be at the Reserve Bank, and we'll get you details of the MPC right here on CNBC TV 18. Well, the country's top bankers are also betting on a status quo policy from the central bank tomorrow. Top bosses of State Bank of India, ICICI Bank, HDFC Bank, Axis Bank, speaking to us at the Mint Banking Conclave, unanimously asserting that the worst could be behind the economy when it comes to bad loans and even credit offtake, and all unequivocally believe that tomorrow there will be no rate action from the Reserve Bank. They expect a hold as far as rates are concerned.
I don't expect a rate hike.
Tomorrow?
Tomorrow.
And when do you expect a rate hike?
Difficult to say. There are factors for and against. The US interest rate going up, potential inflation, etc. But on the other hand, there is also a desire that the rates must be kept at a level which will promote economic growth. Let's see how that plays out. I'm not really an economist to comment, but my gut is it's going to be a fair amount of stability and calmness.
Okay. You cut your MCLR up to 1 year yesterday,
Not 1 year,
right?
6 months, I think.
Up to 6 months MCLR you cut.
That's a more tactical thing with respect to particular
It's just a question of that bracket, that particular bucket, what's the cost of money? Yeah, Shika?
I'm not expecting a rate hike tomorrow, but...
rate hike, a rate cut also, whatever you say. I said any rate action.
No, I'm certainly not expecting a rate cut.
Okay.
And I'm not expecting a rate hike either. And it's very hard to predict when that will happen. There is an expectation that while inflation fears are there right now, some of that could moderate a couple of quarters from now. So I'm sure RBI will be watching all of that as they think about what they do.
Sir?
So no action. I also think tomorrow no action.
Yeah.
Regarding when the rate hike will come?
Allah knows.
So, one thing I can say with certainty as of now is that rates are not going to go down.
Okay. Tomorrow? Okay. Okay. Chanda?
Tomorrow, I don't expect any rate change, but yes, rates will go up. When the monetary policy rates go up, we don't know, but I think the deposit and lending rates, you are already seeing some increase in the market rates already.
So even if the policy rate remains the same 6%, we may see the banks jacking up their loan rates.
But
right?
deposit rate, yeah, because they, you know, those lending rates are really related to deposit rates.
Okay. So you agree with that, Mr. Puri? Even if the policy rate remains at 6%, banks may hike their loan rates?
But that's not what she said. She said...
That's what she said.
Let me give you my view as to what I understood what she said. The bank's rates are dependent on the deposit rates. If the deposit rates go up, it's a mathematical certainty that the lending rate will go up. So that you have it in proper...
Shika, what Chanda said is this. Of course, he is interpreted in a different way, that even if...
Right?
Yeah, exactly. I said the lending rates are dependent on deposit rates.
Even if the policy rate remain the same, there is a possibility that banks will hike their deposit rates and also loan rates, because deposit rate is going up, so that loan rates will go up.
So,
yes? Correct?
So I think it's absolutely right. More than the policy rate, it's the liquidity environment which determines what happens to rates. Given that liquidity is just tightened so significantly over the last few months.
Yeah, but that with the government spending, it will ease in the next few weeks, right?
There doesn't seem to be any signs of it, and March is typically a tough period anyway.
Okay.
So
okay.
Sure. There is cost pressure.
Shika is saying it's very important.
Yeah.
The fact of the matter is, at this point of time, if we want with a recovery, we would strongly recommend that there should be easier money market conditions.
Okay.
Even with what the government is spending, the stated policy is neutrality, which is not conducive to a declining or a stable environment. It will lead to an increasing interest rate environment.
So just look at what's happened to the 10-year.
I don't know what they'll do, but I'm just...
Look at the 10-year government treasury. I mean, it's crazy, right?
Prabit, last word is yours.
No, I don't expect any change in rates tomorrow, but I think the point Shika made is the right one. Think about the last 12 months, 10-year treasuries are up 130 basis points.
Yeah.
So, I mean, rates are up, liquidity is tight, and I think that should give you an indication of what's going to happen in the future.
Do you think the large part of bad loan recognition is over, and now we are in a phase of resolution of bad assets? And if that is true, how long that will take?
So the positives here are that, you know, the resolutions seem to be moving in a time-bound manner. If not 180 days, 270 days, but there's a finite time-bound manner in which resolutions would happen. Secondly, I think this also forces all the stakeholders to sit together and arrive at a certain decision in a time-bound manner. So again, you know, the delays that were happening on account of non-arriving at decisions, I think that also moves better. The third is that for the operating assets, we are actually seeing very good interest, both in terms of the number of bidders, the type of bidders. You have bidders from strategic side to financial side to combination of strategic and financial side and so on. So I think these are all the good signs.
all the large accounts that are there, we have 1.5% market share. So we're really not involved in that process actively. But as far as the smaller accounts are concerned, like a cement company we handle, or a couple of cement companies we handle, a number of those things, we are seeing progress there. There is enough amount of expression of interest, and whatever price we are going to get or likely to get are going to be higher than the amount at which the book value is. But we need to see more of them happening. On the other hand, there are certain categories of assets such as real estate, where there is a discussion around whether the consumer interest comes first or the banker's interest come first, and that discussion is underway. So we might see some of those things working a little slower. That broadly is my summary of the position. But we need to see more examples. We need to see more transactions being brought into the NCLT, and it's going to be a process that's going to take 12 to 18 months at least.
The NCLT process has been a big game changer, and I think the fact that the government has been responsive in looking at what amendments are required to the NCLT process to make it more effective, I think gives all of us bankers a lot more confidence that this is actually going to result in a game-changing outcome. It's not just a policy initiative, it's actually going to result in a game-changing outcome. We've seen a couple of bids coming through. The good news is that because the economy is turning, see, if the economy was not going anywhere, you could have had the NCLT process and you may still not have had people interested in bidding, and bankers wouldn't have seen value in those assets. But because the economy is turning, and if you take steel in particular, if these bids were called 1 year back, I don't know what the loss given default ratios would have been. But the fact that the bidding is happening now and that sector has changed, I think we're going to recover fairer value for those assets.
Banking is a simple business. So you price to cover your cost and your probability of default and a return to the investor. So the level of NPAs is not important. What is really important is whether your probability of default on your products matches with your pricing. In which case you can continue and the level is not relevant. So at least for our bank, we can say that our probability of default on any product has not exceeded what we had budgeted into our model. So on an ongoing basis, NPAs will come, NPAs will go. That is a part of banking. If you price it right, you can provide for it, right? The second part is, obviously, during certain times, there are cycles. There will be a situation where in certain sectors, you will have excessive defaults.
One question about this NPA recognition. So one is that with confidence, I can say that if you looked at the stressed assets, and forget the differentiation for a moment between a stressed asset and NPA, then that stressed asset level is not going up. Then there was a time when most of the sectors seemed to be stressed. But now, if we analyze sector after sector, some of the sectors are on a recovery path and some are still not. So where, for example, it has been mentioned about the steel sector, it is on a recovery path. But the problem still remains on the power sector fronts. And recognition, if it does not happen, in some accounts it will happen in this quarter and at best by March quarter for most of the banks. Resolution part, because NCLT is a time-bound process, at least whatever cases have been referred up to 31st December. So the timeline is that by September you will have the, what do you call the resolution? Resolution means
270 days.
270 days. Yeah. And in 270 days they have to be resolved. And as Madam was mentioning that first list, most of the cases the bids will be received by 15th or 20th February. And in resolution, the recovery will vary from asset to asset. Even in steel sector, we cannot have a thumb rule that we will recover this much. Each asset is different, their liabilities are different, and depending upon their liabilities to various type of creditors, the recovery for financial creditors will be different, but we have seen the worst case scenario of 6% and the best case scenario of 100%.
So two headlines there from India's top bankers. The worst is behind us when it comes to recognition of bad loans. Now it's time for recovery and resolution. And the second, no one is expecting action from the Reserve Bank tomorrow, but they do expect the rate cycle to turn, i.e. rates are likely to move higher in calendar year 2018. When is the question? Time for us to head into a break, but on the other side, we tell you what to expect from India's biggest auto event, the Auto Expo 2018. Well, the Auto Expo kicks off tomorrow. Close to 25 auto manufacturers will showcase their latest cars and bikes with a special focus on electric vehicles. Utkarsh tells us what we should expect from top auto manufacturers. Utkarsh, there are a few companies that are giving the Auto Expo a miss, but the ones that will be there, what should we expect? What are they showcasing?
We are hours away from the Auto Expo 2018, so let's have a look at what is expected in this edition of Auto Expo. Let's start with Maruti Suzuki. We can expect the EV concept to be shown. Now remember that Maruti Suzuki has said that it will be showcasing and launching its first electric vehicle by 2020, and we can catch a glimpse of it. Speaking about the compact SUV concept, now this is called the Future S, and this vehicle will be positioned below the Vitara Brezza and will compete with the likes of KUV 100. Then the new Swift, we all have seen this vehicle. We all are awaiting the pricing for it. Speaking about M&M, 6 new electric vehicles is what we are expecting from M&M. So we can see the SUVs also coming in electric vehicles from M&M. We're expecting the KUV 100 for sure to be showcased by M&M. Speaking about the global SUV, this can be the U321, which is the MUV by M&M. Now this is the first vehicle which has been developed in the North America Technical Center of Mahindra & Mahindra, and this will compete with the likes of Toyota Innova. Then the Stinger concept of XUV 500 can also be seen tomorrow in the Auto Expo. Let's speak about Tata Motors now. The electric Tigor, the car which won the EESL order, will be showcased to the common audience. We're speaking about the H5 SUV. Now this is the SUV which is built on the Discovery platform, and this is supposed to be launched in early 2019. We can catch a glimpse of that. And then the M451, which is the AMP platform. Now this will be a premium hatchback competing with the likes of Baleno and Elite i20. We can expect this to be launched by the late 2019. Now speaking about Hyundai Motors, not a lot from Hyundai this time. We can see the new Elite i20, but this will be more of a facelift. The Ioniq EV will also be showcased, but Hyundai has said it will be launching its electric vehicle in India by 2019. And it will be an SUV. So we really don't expect Ioniq to hit the Indian roads, but this is more to showcase the electric capabilities of Hyundai. Lastly, speaking about Kia Motors, now this is the biggest launch in Auto Expo. Kia Motors will be launching in the country by 2019. So around 16 of its UVs from the current portfolio will be shown. But what is more important, that the SP concept of the SUV, which will be a global showcase of this concept in the Auto Expo. This is a Make in India and Make for India vehicle which can be seen in the Indian roads by the end of 2019. So this is from the top 5 manufacturers. Obviously, there is much more to the Auto Expo, and you can catch all the glimpse. Will be with you for the whole coverage of Auto Expo from tomorrow morning.
All right, thanks very much. Watch out for our coverage of the Auto Expo. Utkarsh and Ron will bring you the action from there. But the big political story, the Congress President Rahul Gandhi has called the Rafale deal a scam. Now, this is interesting because this comes after Defence Minister Nirmala Sitharaman refused to give details of the agreement for 36 jets in Parliament. The Defence Minister refused to divulge the details while answering to a written Parliament query from Samajwadi Party member Naresh Agarwal. Rahul Gandhi also went on to accuse the Prime Minister himself of favouring a businessman. The government, in its written reply in Parliament, has said that they cannot divulge details of the Rafale deal because of a secrecy pact that has been signed with the government of France. Listen in.
मोदी जी ने पर्सनली ये डील कराई है. मोदी जी पर्सनली पेरिस गए हैं, पर्सनली वहां पे डील चेंज की गई है, पूरा हिंदुस्तान जानता है. और रक्षा मंत्री जी कहती हैं कि हम हिंदुस्तान को और जो हिंदुस्तान के शहीद हैं उनको और उनके परिवारों को राफेल डील में कितना पैसा, क्या रेट लिया गया है, उसके बारे में नहीं बताएंगे. क्या मतलब है इसका? एक ही मतलब है, नहीं एक ही मतलब है ना, एक ही मतलब है कि कोई ना कोई घपला हुआ.
And on to action from the upper house of parliament. A united opposition boycotted the Rajya Sabha today. This after alleging that the House's chairman, Venkaiah Naidu, was not allowing opposition leaders to speak or raise any governance issues. The Congress leader of opposition in the Rajya Sabha hit out at the BJP, saying that the voice of the opposition was being muzzled. The BJP then hit back with Finance Minister Arun Jaitley, accusing the opposition of running away from a debate.
What the opposition parties have done in the Rajya Sabha today, led by the Congress party, is absolutely unprecedented. The Congress and some other parties have tried to manufacture an issue where none existed.
Okay, that was the big political story of the day, but for now we're going to take a very short break. Up next, a CNBC TV 18 special report finds out that food adulteration in India has doubled in the last 5 years alone. So what exactly is the reason behind this sharp spike? Priya Sheth will join in with details on the other side. Stay tuned for that.
Well, on to a CNBC TV 18 special report. Now, we've analysed reports of the Food Safety and Standards Authority of India for the past few years, that's the FSSAI, and have found that food adulteration in India has almost doubled in the past 5 years. Priya Sheth joins us now with the numbers. Priya, what does the data reveal?
Well, that's right. Data analysed from FSSAI annual reports over the last couple of years has revealed that food adulteration rate in India, or the percentage of food tested by government which was found adulterated, has almost doubled over the last 5 years. Over 60,000 food samples were analysed by public, state and central food safety labs in FY17. Now, out of which 23% of the samples were found to be unsafe. Now, compare this to a 13% adulteration rate found in FY12, and this, as you can see, is showing the gradual increase in the food adulteration rate over the last 5 years. Now, do remember that here we're talking about the food that has been both adulterated as well as substandard. Now, this has not gone unnoticed by the state and central food safety officers. The conviction rate derived from the number of civil as well as criminal cases launched has dramatically increased from 11% in FY12 to 52% in FY17. This indicates that stringent action is being taken by officials. Now, interestingly, the data also gives us a state-wise split as far as states are concerned on which states had the highest food adulteration. Now, significant states among those are Punjab, which had the highest food adulteration rate at 55% in FY17. This is, of course, followed by Uttar Pradesh, Kerala as well as Chhattisgarh. Now, even back in FY12, Chhattisgarh as well as Uttar Pradesh had the highest adulteration rates. Now, let's look at the states with the lowest food adulteration rates. Bihar, Meghalaya as well as Gujarat had the lowest food adulteration rates as far as FY17 is concerned. This clearly indicating that either the food quality in these states is genuinely good, or there are some loopholes in the inspection and testing. Now, back in FY12, Karnataka as well as Gujarat had the lowest food adulteration rates, with increasing focus on quality, self-regulation as well as good manufacturing practices. It does remain to be seen how this shapes up going forward.
A significant hike as far as food adulteration is concerned, and that is something that FSSAI is perhaps likely to take up very soon. Thanks, Priya, for taking us through that. Now, let's move on to an exclusive from the divestment space. CNBC TV 18 learns that the Ministry of Railways is likely to push for the Dalal Street debut of Indian Railway Finance Corporation, or the IRFC, this fiscal itself. Ashpreet Sethi has exact details. Ashpreet, what is the exact timeline that you're looking at, and how much are they likely to raise?
Well, it's quite a relief coming in for IRFC, the first rail PSU which is likely to be listed. That is what we are picking up from sources. Now, remember, the budget had cleared last year as far as listing of 9 PSUs is concerned. However, none have been listed so far. IRFC was in a soup because of deferred tax liability issues. The MCA has issued a notification now which paves way for listing of the rail PSU. Now, as far as deferred tax liability is concerned, the provisioning was done for about 6,000 600 crores, which was leading to a depressed valuation of the rail PSU, which is why the railways was not able to take it to the market. However, with this MCA notification, now decks have been cleared, and what we pick up from the Railway Ministry is that they're going to go ahead and push the IPO listing as far as this fiscal itself is concerned. We'll have to wait and see what procedure will they take, because they will have to send their proposal to SEBI, and then the final decision will be taken by SEBI. But as far as this MCA notification is concerned, it also clears decks for remaining rail PSUs which have been pending clearances as far as listing is concerned.
Okay, fair enough. So a couple of important notes that are required, but yes, this is something that the government is likely to push for. Thanks, Ashpreet, for taking us through that. We will have to take a very, very short break on that note, but on the other side, we will bring you all exclusive details on the race for JP Infratech's assets. Stay tuned for that story. Welcome back onto a cnbc TV 18 exclusive. We learned from sources that at least 5 bidders have entered the fray to buy debt-laden JP Infratech's assets. Now remember, JP Infratech has a debt of over 10,000 crore rupees on the back of incomplete housing projects. Nisha Poddar is here to take us through the details. Nisha, so who exactly are the bidders that have submitted bids for JP Infra so far?
Soon after the Supreme Court refused to put a stay on the bidding process for selling the debt-laden JP Infratech, we gather from sources with direct knowledge that definite bids have really been submitted for buying out the assets and whole of JP Infratech. Amongst the big bidders are Adani Realty as well as JSW Group, which have shown keen interest and have put in bids for buying out the whole of JP Infratech. We also gather from sources with direct knowledge that Cube Highways, which is Singapore-based investment firm, which has also submitted bids for buying out the whole of JP Infratech. What's also interesting is that there's fair bit of interest seen in the hospital asset of JP Infratech as well, and for that some of the other hospital players like Apollo Hospitals as well as Radiant have also submitted bids only for the hospital assets. So this will be a hotly contested battle, and let's see where it goes. But debt amount is huge on JP Infratech, 10,000 odd crore rupees, and also remember there's this unfinished housing project which also requires fair bit of funds.
Okay, Nisha, we'll leave it at that, and that's of course a developing story that we will be tracking here. But for now, we'll have to wrap up this edition of India Business Hour. Thank you so much for watching. Good night.